Very good afternoon, everyone. Uh, Very respected speaker for today, CA Surbi Bansalji. So I welcome Surbi ji in today's webinar. Our very young and dynamic, the chairman, of course, CA Abhishek ji, Abhishek Singh Sohan ji from Chandigarh. So welcome, Abhishek bhai. And the moderator of today's program, Ayushi Khanna ji. So welcome, Ayushi ji. Today we have a third day of this, the program, the FEMA and the investing in the gift city. So I would, of course, always appreciate our chairman here, Vinam Agarwal ji, because, under the guidance, of course, so many things, he has decided about the profession, for the validation for the profession, whether we talk about student or the member. So we always, as a team of NIRC, always appreciate our chairman of NIRC here, Vinamji, because these type of programs are very important for the members. Otherwise, when we do the seminar, or the number of speakers not available physically, but with the help of this webinar, so we can connect the speaker from different city, different country. So that is why the team of NIRC has decided these type of things. So once again, I welcome. And very interesting topic, FEMA. So today, Surbiji will take the topic that is a tax consideration for the overseas structuring and the gift city. Very important and very, I would say, because she has a very deep knowledge about this topic. So we are waiting for Surbiji for her deliberation. Thank you. Thank you, Ayushi. Over to you.
Thank you, sir. Now, I would like to ask our coordinator, sir. So this is for the first time I'm connecting, but I'm too impressed looking at a young chairman handling the whole Chandigarh branch. So I would request you to address our participants. Over to you, sir.
Thank you so much, Ayushi. My throat is not working, so I hope you will pardon me. First of all, thank you so much for giving me the opportunity. I would like to thank Abhinav sir, the entire NIRC team. First of all, I would like to thank Survi Bansal ma'am for sparing their valuable time for the members of the fraternity. And before I start delivering anything, I must congratulate the young and dynamic chairman of NIRC, who is continuously working day and night for the upliftment of the profession. And when I saw this, when I got the opportunity or call from Abhinav sir that this type of initiative that we are taking upon, that we want to take up the topics which are not frequently touched upon for the professionals. So I was very happy and looking forward that what are the new kind of topics. And when I saw the list of the topics like FEMA or the investment in the gift cities, that is the future perspectives that every professional must look upon. So these are the great initiatives, Abhinav bhai. You should keep on working on this. I am in any case, I can be any of help. I'll always be available. Other than that, I would like to thank all the participants who have spared their valuable time for listening to this in the last 2 days. They have gained a lot, I must say. The speakers were really good, and from today also, I can vouch for that. That from the Survi Bansal ma'am's lecture, you all are going to get a great benefit. With this, again, a great thank from my side, sir. Thank you so much for giving me this opportunity. And please, over to you, Ayushri. Let's you can carry on with this.
Thank you so much, sir. And I must say, this is not the one series, but Abhinav sir is actually running multiple series with his whole team. So congratulations, sir. And I need to add that this is not only working on the professional aspects of our lives, but the personal too, because some on the mental health and something regarding their personal life are also introduced to the chartered accountants, which are totally ignored by us running towards our profession. So here's the time to call our speaker. And ma'am, already the team members, already the NIRC team and Abhinav sir themselves have already introduced you. But I was too impressed to go through your profile because you have almost experience of more than 20 years. And I must say, you never look like that. I've seen your profiles where you never look like that. So she's experienced enough. Handling the specialization inter alia includes structuring inbound and outbound investment, developing transfer price control framework, for MNCs, and there are multiple fields in which she is expert enough, and today she has found some time for all of us. Ma'am, we are eagerly waiting to listen from you. Now you can present your screen and over to you. Thank you.
Thank you, Ayushi. You have already taken all my heart.
Sorry to interrupt you, ma'am.
Yes, please.
I would like to our chairman, sir, Sri Abhinav Agarwal ji, for your kind words, sir. Kindly enlighten us, sir.
I'm sorry, sir. Over to you.
No, thank you, Ayush ji. Thank you. A very good evening to all my participants of today's session. My London speaker, CS Surbhi Bansal ji, to whom I know approx around 13 to 14 years. 13 से 14 सालों से मैं मैम को जानता हूँ. अभिषेक भाई, अभिषेक चौहान जी, he is also a good speaker and a professional teacher in Chandigarh, and under their guidance, so many students become a chartered accountant. Our today's session moderator, Ayushi ji, I want to welcome all of you in our third Gurukul series, and this is the last day of this series. And all of the 3 days, we have covered the different types of topics, which is very, and I can say in today's scenario or today's arena, it is very important for our professional opportunities, and really our all the speakers justify the topic, and it will really helpful to our members also. मैं आपको ये भी बताना चाहता हूँ कि हमारी जो ये डिफरेंट सीरीज है, इसका मोटिव वन एंड वन ओनली यही है कि जो मेंबर्स इन इंडस्ट्री और जो मेंबर्स एट होम हमारे फिजिकल सेमिनार्स अटेंड नहीं कर पाते किसी भी रीजन की वजह से, फॉर दैट पर्पस ओनली वी हैव स्टार्टेड दिस 9 टाइप ऑफ सीरीज अंडर डिफरेंट लोगोस. लाइक आप शक्ति सीरीज है, हमारी स्टार्टअप लैब सीरीज है, हमारी संपूर्ण सीरीज है, गुरुकुल सीरीज है, आप टेक सीरीज है, अंडर विच हम टेक्नोलॉजी रिलेटेड प्रोग्राम्स बताते हैं. तो डिफरेंट हमारी 9 सीरीज है. क्रीडाशाला है जिसमें हम संडे आयुष्मान हेल्थ रिलेटेड प्रोग्राम्स कराते हैं. मेरी यही रिक्वेस्ट है सारे मेंबर से, आप जैसे जो भी कम्युनिकेशन आपको हमारे जिस रेफरेंस से मिलते हैं, चाहे मेल आइदर और सोशल मीडिया, आप इसे मैक्सिमम नंबर्स में आप अपने सर्कल में सर्कुलेट करें ताकि इसका बेनिफिट मैक्सिमम चार्टर्ड अकाउंटेंट्स को मेंबर्स को मिल सके. और अभी नेक्स्ट सीरीज हमारी जो है स्टार्टअप लैब के ऊपर है, वो 21 मई की है. एक हमारे स्पीकर है अवेलो रॉय, जो कलकत्ता से हैं, बाहर से आ रहे हैं. और बहुत ब्यूटी ऑफ दिस सीरीज यही है कि हम जो डिफरेंट एक्सपर्ट स्पीकर्स हैं इन डिफरेंट फील्ड्स, तो जो हम दिल्ली से लोकल नहीं आज आ सकते ड्यू टू एनी रीजन की बाहर से हैं, तो वो भी इन ऑनलाइन सीरीज में ज्वाइन कर लेते हैं. तो आप 21 तारीख की स्टार्टअप के ऊपर हमारी 21 मई को सीरीज है, तो प्लीज उसको भी ज्वाइन कीजिएगा. थैंक यू. ओवर टू आयुष.
Thank you so much, sir. In the excitement of your multiple series, I missed asking you to introduce the participants. So without wasting much of the time, I would ask our guest speaker, and she is going to have her co-presenter. And over to both of you, please go.
Sure. Thank you, Arushi. And Abhinav, really impressive. All these series, I have just gone through them few days back. That what all institute has taken these initiatives, they are really impressive, and heads off. Yeah. So we'll just start. Please allow a moment. I think this should be visible. Can anyone confirm? Yes.
Yes, ma'am.
Okay.
Yes, ma'am.
Sure. Okay. Thank you. So see, first we'll be broadly discussing about what is going on in international taxation, what structurings we used to do, how they have now changed with the time. And then we will be coming to the very specific provisions which are there for ODI. So broadly, I'll be taking upon some general concepts, and later on, my colleague Agartha would run down through most of the provisions which are relevant for today's discussion. And see, when we talk about the cross-border structuring, I think what is really important is to start with one of the Supreme Court case. In the case of McDowell's, it was in year 1985. And when it was held by, it was observed by Supreme Court, that tax planning may be legitimate provided it is within the framework of law. Colorable devices cannot be part of tax planning, and it is wrong to encourage or entertain the belief that it is honorable to avoid the payment of tax by resorting to dubious methods. Okay, so this was way back in 1985. To understand more on international taxation, let's go a little more beyond. So we will go in the past, in the beginning of the 19th century. So see what happened, the cross-border transactions, they began. So earlier, less of cross-border transactions were there, and in the beginning of 19th century, it started. Definitely, when it started, the problem of double taxation emanates, that both the countries, they are taxing same incomes. So there was no concept of double tax treaties. And then League of Nations, they came into picture, and in 1928 they developed a framework treaty, which was which then become the model treaty for all these concepts for avoiding the double taxation. I mean, we call them bilateral tax treaties these days. And then what happened? So everything was going in the right direction. So we have double taxation treaties. And then what happened, that MNCs, they started misusing these treaties. And when they started misusing, so what happens, that there was a concept of double non-taxation, and which was something which disturbed the entire world. There are three type of economies if we talk about the whole world. One is the developed economies, and second is developing economies, and third is the US. US in itself is an economy. So three model treaties were developed. One, OECD, which was more towards developed economies, and another was the UN Model Tax Treaty, which was more for developing nations, and there was a US Model Tax Treaty. So when we see, I mean, those who study the international tax, they would be aware about these three type of model tax treaties, and the bilateral tax treaties are more or less, they are divided into these three categories. Later on, what happened, that the problem, how the problem starts. Suppose there's a US company, MNC, and what they did, that they transferred their residency into maybe a Cayman Island or a BVI, British Virgin Island, or some other tax haven jurisdiction. So these bilateral treaties, what happened, that they give a leeway, a leverage to these MNCs, that they are not taxed at all. So there was a case of double non-taxation. And that is something which was grossly incorrect. And not only the developing countries like India, but most of the nations, even the developed economies, they were badly hit by these tax planning structures. Another problem that comes in the way was the globalization. So the globalization has totally, the territorial nexus, which was there, which was the basic principle, fundamental of our international taxation. So currently we are undertaking this call on a Zoom. Zoom is a US-based MNC, and they have entered into India, and they do not have any physical presence or any territorial nexus. Still, they are able to earn money from India. So what happened, that because of this, these challenges, these are the two challenges which happened. I'll just again, for everybody's this thing, I'll just repeat. Challenge number one was the usage of tax treaty. So we call it as treaty shopping. And the other problem which was there was the globalization and not having appropriate mechanisms to tax the digital economies. So there were, then in 2015, OECD and G20, they come together, they make an inclusive framework, and they come out with some action plans. You all must have heard about these BEPS action plans. So there were 15 action plans, and each action plan was supposedly to address some of these issues in one way or the other. So if you'll see in our in our Finance Act, we have seen amendments under international taxation. Most of them are derived from BEPS action plan, be it thin capitalization, be it this SEP, which is significant economic presence, and lot more like CBCR, master file, everything. Each of them is emanating from these 15 action plans. Also, to address another measure which was taken, we call it as BEPS 2.0, wherein two pillars, Pillar 1 and Pillar 2 was introduced. So Pillar 1 and Pillar 2 again was to address the same issue, that the source should be, that the source country should get an appropriate fair share, and Pillar 2 to address that there should not be a rat race amongst the jurisdictions to just low down the tax rate to have the companies, entities set up there. So if we put them together, so all three things, 15 action plans, the signing of the multilateral instruments, and the BEPS 2.0. BEPS 2.0 is yet in the implementing phase. It has not yet been implemented. In fact, India has not taken any, given any major guidance on Pillar 1 and Pillar 2. But rest of the world, they have already taken cognizance of Pillar 2. And a lot of things have already happened in many of the jurisdictions. But as far as MLI, we talk about MLI, yes, definitely India is signatory to MLI, and I believe, most of you would be broadly aware about that what MLI is. So it's a multilateral instrument where we used to have treaties like one on one. So it's a bilateral treaty between two parties together. But because there were some major things happening in the international world, so this MLI is something which even on signing of the one single instrument, it will be applied to all the treaties put together. So this was something which was carved out to have a multilateral instrument and to update those bilateral treaties. So if, as on date, if we read any bilateral treaty without reading this MLI or without having cognizance of the multilateral instrument, it is definitely of no use. And see, the reason why we are talking about this here in cross-border structuring is this only, that one of the major tests which is there in multilateral instrument is the principal purpose test. So as the name suggests, the principal purpose test means if you are entering into any jurisdiction, the principal purpose to enter that jurisdiction should not be reduced taxation or double non-taxation. So, for example, earlier we used to structure the outbound investments or the inbound investments through many of the tax havens like Mauritius. So if Mauritius treaty provides for the principal purpose test, or the Dubai treaty provides for the principal purpose test, or any other treaty for that matter, then we have to be very cautious while doing any sort of cross-border restructuring, because that restructuring is definitely going to hit by these provisions. it says that if the principal purpose is to have to do a non-taxation or a taxation at a lower reduced rate, and it is established that the objective was to have these advantages would be denied. So the whole structuring will go for a toss. And therefore, so I just want to conclude here that where these changes, after these changes, any Indian outbound or inbound cross-border structuring of investment routed through overseas jurisdiction should factor in BEPS and MLI impact, especially if the structuring involves availing of tax treaty benefits. So it is not the same which it used to be maybe 5 years down the line. I'm just moving to the next slide. So see, this slide will just give you the broad coverage that what all we are going to cover in this presentation. So because it is about ODI is overseas direct investments or overseas investments. So when we talk about overseas investment, that means something which is going out of India. And when we talk about FDI, it's incoming and coming into India. So here the presentation is restricted, is confined only to ODI. That is when there's an overseas investment, that is the funds are flown from India to outside India. And what all we would be covering here is, of course, when there's a flow of fund, there would be 3 instances. One, when it is actually been, when the funds are infused. Second, when there is some income. And third, of course, when there is an exit. So we will be discussing the taxability on each of these instances. And also these investments can be made in form of equity and loan as well. So this, I think, we must have already covered in our in the presentation on 15th of this month, wherein ODI and OI has been already taken in greater details. So here we would be covering the taxability, the credits. Again, the tax credit would be very important. So how this FTC can be availed, what is Form 567 and every such thing. The compliances which are required to be done, the place of effective management, how it triggered, what should be done to, what precautions to be taken, the transfer pricing angle of the same, and the disclosure requirements. So broadly, this would be the coverage in the overseas investments, and a little bit about GIFT City, as the GIFT City was extensively covered already in the yesterday's session, and the tax as well. So we will be confining here to the overseas direct investments and the GIFT City implications on the Indian investors. So there's a lot on non-resident investors as well. We'll be confining here only to the Indian investors. So next slide will be taken up by my colleague Agartha. She'll be running down the provisions of each of these acts, provisions.
Thank you, ma'am. Good evening, everyone. Hope my voice is clear to everyone. Can anyone confirm?
Yes, it is clear.
Okay, thank you, Ayushi.
Yeah.
So before starting with the taxability of overseas investment in India, I would like to give a brief of the principles of taxation. It would be important to study to discuss the later on slides. Thank you. So under principles of taxation, we would discuss the income that can be subjected to taxes in India. Taxability of an income in India is dependent upon the residential status of the person. So if we talk about the residential status, our Act provides that for individuals and HUF, the residential status could either be that of a resident but not ordinarily resident, or it could be a non-resident. Categorization of the residential status is primarily dependent upon the period a person stays in India. For assessees or for persons other than individual and HUF, the residential status could either be resident or non-resident. So if I talk about a company, if there is a company which is registered and incorporated under the laws of India, then for taxability purposes, it would be considered as a resident company in India. While if there's a company which is not registered under the laws of India and its place of effective management also does not lies in India, then for taxation purposes, such company would be considered as a non-resident company or a foreign company. So to determine the taxability of a non-resident company, place of effective management holds relevance. And this phrase we would be, which is abbreviated as POEM. So this phrase we would be discussing in detail in the later part of this session. Now, after determining the residential status of a person, next step would be to determine what type of income that person is earning in India and whether that income can be subjected to tax in India or not. So we have Section 5 of the Income Tax Act in place, which provides for the scope of total income of a person depending upon its residential status, which can be subjected to tax in India. This table summarizes the provisions of Section 5. As we all can see that in case of a resident assessee, resident assessee could be an individual or company, all type of Indian sourced income would be chargeable to tax in India. And if there is any foreign sourced income, that income would also be subjected to tax in India. In case of non-resident, only the Indian sourced income would be subjected to tax in India, and there won't be any taxability relating to foreign sourced income. In case of resident and not ordinarily resident assessees, so this category is specific to individuals and HF, it is not applicable to a company. In case of RONORs, only Indian sourced income would be subjected to tax in India. Foreign sourced income can be taxed in India only if certain conditions are fulfilled. So for the purpose of this session, we would be concentrating on the income of a resident, on the taxability of a resident company arising from overseas investment. So we all should keep one thing in mind, that we are talking about a resident company, a resident assessee, and as per the provisions of the law, its global income would be subjected to tax in India. This is the basic fundamental we all will keep in mind.
Yeah, see here the emphasis is this only, that it is when we talk about an ODI, so or an overseas investment, so it's being done by resident, and for resident the income, the global income would be taxed, whether it's an Indian income, foreign income. So first thing is it will be taxed in India. Whether the credits would be available, whether the credits would not be available, we'll be discussing in the subsequent slides. So just to put the principle here, it has been mentioned.
Now coming to the overseas investment, we already had a detailed discussion in the first session wherein Ms. Sudha has explained in detail what overseas investment is and what are the governing rules and regulations. We all know that we have overseas investment rules, regulations and directions in place which guides how overseas investment can be taken up by the Indian investor. Just to give a brief of the overseas investment, I would like to reiterate that overseas investment could either be ODI or OPI. ODI is overseas direct investment and OPI is overseas portfolio investment. Both the investments are the equity participation, are in the form of equity participation by an Indian investor, but they are being categorized under two categories, wherein for ODI we have four limbs. Where there is acquisition of unlisted equity capital of foreign entity, it would be ODI. Where there is subscription to the MOA, it would be ODI. Where there is investment in the listed foreign entity and the investment is more than 10% of the paid up equity capital, it would be ODI. And where the investment is less than 10%, but there is a control of the Indian company in the foreign listed entity, then again it would be ODI. So what will be OPI? OPI is investment which is not ODI. So say, for example, if there is an Indian company making investment in foreign listed company with 10% or less equity, with less than 10% participation, having 10% less than 10% participation, and there is no control, such type of investment would qualify as OPI. Let me tell you one thing, whether it is OPI or ODI, they stand on the same footing as far as taxation provisions are concerned. So whatever provisions I'll be discussing in the later part of this slide of this session, they would apply to ODI as well as OPI. Now another type of the overseas investment could be in the form of debt, wherein an Indian company may advance loan to the foreign company. Then third type of overseas investment could be a non-fund based facility, wherein, for example, an Indian company may extend guarantee for a foreign company. So in this session, we would be discussing overseas investment by an Indian company in the form of equity in participation in the foreign company, or it could be in the form of loan advancement, or it could be a guarantee. So we have already studied that these are the regulations guiding overseas investment. Now coming to the phases of overseas investment. When an Indian company makes an overseas investment, there could be 3 possible taxable events. We would be discussing these events into different phases. First phase could be the time when an Indian company makes an overseas investment. So an Indian company may acquire the equity shares of the foreign company, or an Indian company may advance loan to the foreign company. Making an investment or advancing a loan per se is not a taxable transaction in the hands of Indian investor under the provisions of the Act. Having said that, we have various regulations in place which provides that these type of transactions should be at arm's length, or we have certain rules in place which provides that that investment must be made on fair market value basis. So although investment by Indian company is not a taxable transaction, but one has to be very cautious of the fact that we need to adhere to the valuation rules or the regulations applicable on such transactions. So if I say that there is an investment by an Indian company in a foreign company, and the transaction was undertaken at its fair market value, then there won't be any tax implication arising in the hands of Indian company. However, if I say that there is an investment made by a company in the foreign company, by an Indian company in the foreign company, and the issue price and the participation was at a price which is lower than the fair market value, in such a scenario, there is a possibility that a tax implication may arise in the hands of Indian company. So all in all, to summarize, investment is per se not taxable, but one has to be cautious that the transaction must be on arm's length or it must be on fair market value.
I would just like to add here. So the same thing, I think I'm just reiterating. The focus is on that whether the section, whether implication under 56 can be there or not. So 56 provides for a rule as per 11, I mean, the valuation has to be as per 11 UA, whereas the FEMA provides a different set of rules, and they said that the pricing valuation should be as per the internationally accepted pricing methodology. It could be DCF. So there's a possibility that the value as per DCF is different, and the value which is there as per 56 is different. So the likelihood of not being this taxed under the 56, I mean, cannot be just ignored. It should be checked that both the pricing guidelines are adhered to.
So coming to the second phase would be the phase wherein Indian company would receive income from its overseas investment. So as we have said, that investment could either be in the form of equity or loan or extending a guarantee. Accordingly, the possible sources of income could be interest income, which may arise on the loan given by Indian company to foreign company, or it could be dividend income, which may come from the equity participation, or it could be guarantee commission, which may come from the guarantee extended by the Indian company. So first we'll take up the interest income. We have already discussed at the beginning of this session that in case of a resident company, its global income is subjected to tax in India. Now, in this case, if an Indian company is earning interest income from a foreign company, so applying the basic principles of taxation, the income earned by the Indian company would be subjected to tax in India, and it would be taxable at the normal corporate tax rate applicable to such company. There is a possibility that there could be a withholding of taxes in the foreign territory by the foreign company. In such a scenario, as ma'am has discussed it at the beginning of this session, that there could be a possibility of double taxation of the same income. So to avoid these kind of situations, India has entered into tax treaties which contains provision relating to elimination of double taxation. As per those provisions, if there is an income which is earned by the Indian resident outside India and there is a withholding of taxes on that income outside India, then the Indian company would be allowed to claim credit of such taxes from the taxes payable on such income in India. So if I take an example, there is an interest income of 1 lakh earned by the Indian company. There is a corporate tax rate applicable on such income in India at the rate of 30%. For simplicity purposes, we are taking it at 30%. and there is a withholding of taxes at the rate of 10% in foreign territory, then in India, such income would be subjected to tax at the rate of, then in India, the tax payable on such income would be 20,000, which would be 30,000 minus 10,000. So this type, in this manner, credit of taxes can be claimed by the Indian company. To claim credit of taxes, there are certain compliances which need to be ensured by the Indian entities. I would like to discuss these compliances in a bit detail. So we have a procedure defined under the Income Tax Rules 1962 on how an Indian company or an Indian assessee can claim credit of foreign taxes. We have Rule 128 in place, which provides that the Indian company is required to file Form 67 to claim credit of foreign taxes. Form 67 is a very simple form which contains the details of the foreign sourced income earned by the Indian assessees outside India, and the taxes paid on such income outside India. This is the snapshot of the form, which is a very small 2-pager form, which states that the Indian assessee is required to disclose the country in which the foreign income is earned, the source of income, nature of income, amount of income, amount of taxes paid outside on such income, then the relevant tax DTAA article, and the amount of tax payable as per the relevant tax treaty. This is a basic form which Indian assessee is required to file to claim credit of taxes. Along with this form, Indian company would be required to file a certificate received from the foreign entity, which must state the amount of income earned outside India and the taxes paid thereon. So like in India, we have Form 16A in place, which states the income earned, which is issued by the deductor and which states the income earned in India and the taxes paid in India. In the same manner, there could be a certificate which would be issued by the foreign entity or the foreign country. And if there is no such certificate, any other proof of actual payment of taxes would help. So the Indian company would be required to file Form 67, and the due date of filing this form is on or before the end of the relevant assessment year. So if I talk about financial year 23-24, if an Indian company would be filing the return of income on or before November 2024, then the Indian company can file Form 67 along with the relevant documents on or before 31st March 25. Now a question may arise that can Form 67 be filed belatedly? There is no express provision in the Act or a saving clause in the Act which provides that yes, Form 67 can be filed belatedly along with the prescribed fee or penalty. There is no specific provision. However, there are judicial precedents wherein courts have held that a procedural lapse by an assessee should not result into denial of a genuine benefit. So if there is a company which has filed Form 67 belatedly, they can very well put up their claim before the assessing officer based on those judgments. Now, there is one interesting concept in FTC, which is segregation of FTC. Till now, we have taken the simplest of the example wherein we have considered that the income offered to tax by the Indian company is equal to the income on which taxes have been withheld in the foreign territory. Let us take another, so for the sake of simplicity, I'm just repeating this example. There is an Indian company which is earning interest income from outside India in financial year 23-24, and the amount is 1 lakh. The tax liability in India is 30,000, withholding taxes outside India is 10,000. So in India, the net tax payable on the interest income would be 20,000. Now, changing this example a little bit, let us suppose in India, we all know that we follow the financial year, which is April to March. Let us suppose that an Indian company has advanced a loan to foreign company, which follows calendar year, that is January to December. So a loan is advanced by the Indian company to the foreign company in the month of January. And the foreign company follows the calendar year. So they will, and they follow policy of accruing the interest income on 6 monthly basis. So as far as Indian company is concerned, they will close their books of accounts on 31st of March, and they will recognize the interest income following the accrual system of accounting for the period of 3 months, that is January to March. So they will recognize an interest income of 25,000 in the books of accounts. And when they will be filing the return of income for this year, they will offer it to tax. While claiming foreign tax credit, there might be a situation that the Indian company would have the foreign tax credit available for a higher amount for the 6-month interest income. There might be a situation. what would be the amount that would be available as credit to the Indian company in that scenario? So as per the provisions of the Act read with relevant rules, it is very much clear that the credit of taxes would be available only corresponding to the income which has been offered to tax in the ITR by the Indian company. So in our example, if the Indian company is offering to tax an amount of rupees 20,000 in financial year 23-24, then it would be allowed to claim only 2,500, which is proportional to 25,000. It would be allowed to claim only 2,500 as FTC in its return of income. The balance amount
is what we are trying to say, that the principle is the same, that for it's same for the domestic tax credit and as well as for the international tax credit. But earlier there were no clear procedures how to do it, and lot of changes have been brought in through this rule 128 and form 67, and now they have simplified. They have very categorically clearly given the provisions, and it's now very easy to do what the intent of the law is.
Right.
Practically doing it.
Right. The provisions are very much clear, and it is very simplified and clear how a Indian company can claim credit and what is the procedure being followed. So one has to be very cautious about the procedure. If we have duly complied with all the relevant forms and the documents, then it is very difficult for the income tax authorities to deny FTC to an SSC. So concluding our example, the Indian company can claim remaining amount of FTC as credit in the subsequent year's return of income whenever the corresponding income will be offered to tax. Sorry. So sorry. Now resuming our earlier discussion. Is this screen visible to all?
Yes, it is.
Thank you. Now, resuming to our earlier discussion, we were discussing about the interest income received by the Indian company from the loan advanced to foreign company. Just to summarize it quickly, we have discussed that it would be taxable in the hands of Indian company on gross basis. The tax rate would be corporate tax rate. If there is any withholding of taxes outside India, such amount can be claimed as FTC in India, subject to certain compliances. The compliances are first and the foremost is filing of Form 67 along with the relevant documents, and second compliance is the appropriate disclosures to be made in the return of income. So whenever there is an Indian company or there is an Indian assessee making investment outside India in any form or manner, they are required to disclose the investment, the form of investment in the return of income under the Schedule FA, which is foreign assets. If there is any income arising from foreign investment, then the Indian assessee is required to report the foreign sourced income. And if there is any credit being claimed by the Indian assessee, they are required to report the foreign tax credit under Schedule FSI. Under the Schedule of Foreign Tax Credit in the return of income. So these are the two basic compliances Indian assessees should comply with to avail FTC in an easy manner. There is one more aspect to interest income, which is arm's length testing. This we will be taking up in the later part of this session when we'll be taking up TP regulations. Coming to the second possible source of income, it could be dividend income. This may arise from the equity participation an Indian company may have in the overseas company. So again, the dividend income, since it is earned by a resident assessee, it would again be chargeable tax on gross basis in their hands, and the tax rate would be normal corporate tax rate. However, if
just here, I would just like to mention one thing, that earlier there used to be one section 115 BBD. By virtue of that, the dividends were earlier used to be taxed at a flat rate of 15% instead of the corporate rate, tax rate. But now with the abolition of that section, the dividend whatsoever are coming from foreign subsidiaries are now subjected to the normal corporate tax rate.
Although they are now subjected to normal corporate tax rate, the government has compensated the reduced the concessional rate of tax by allowing a deduction to the Indian companies, which says that if an Indian company is receiving foreign dividend and that dividend is distributed by the Indian company to its own shareholders in the very same year, then the amount of dividend distributed by the Indian company to its shareholders would not be subjected to tax in the hands of Indian company, and it would be subjected to tax in the hands of shareholders only. So let's understand it with the help of an example. There is an Indian company who has made investment in the foreign company. There is a dividend of 1 lakh received by the Indian company. This rupees 1 lakh was distributed as it is by the Indian company to its shareholders. In this situation, there would not be any tax payable by the Indian company on the foreign dividend, as there would be a deduction available under Section 80M of the Act. So there won't be any tax in the hands of Indian company. Taxability would arise in the hands of shareholders, that which would be as per the normal applicable slab rate or the applicable tax rate. Another example, if there is an Indian company receiving foreign dividend of rupees 1 lakh and 80,000 is distributed as the dividend to its shareholders. So this 80,000 would be taxable in the hands of the shareholders, but the balance 20,000, which is not distributed by the Indian company, would be chargeable to tax as dividend income in the hands of Indian company at the corporate tax rate. So this is the benefit given by our government to the Indian companies, wherein they have been given pass-through status if they pass on the foreign dividend on as-is basis to its shareholders. As we have discussed in case of interest,
I think here one more discussion we can just look into is that, for example, there could be jurisdictions where the tax rate is low. For example, in Dubai, it's 9%. And after payment of taxes there, the dividend is repatriated to India and then to the shareholders. So again, there's a possible tax saving there, because if had it been earned in India, it would have been first subjected to 25% tax, and then it will be taxed in the hands of shareholders at their slab rate. But anything which is there in a jurisdiction which is taxing at a rate which is less than the Indian corporate tax rate, so there would be a proportionate saving to that extent.
now, as we discussed in case of interest income, there could be a withholding on dividend income as well in the foreign territory, subject to their local laws and the applicable tax treaties. For dividend income as well, we have provisions in the tax treaties to eliminate the effect of double taxation, which says that if there is a tax deduction outside India, then the Indian entity would be allowed to claim credit of such taxes on the tax payable on such dividend in India. There are certain tax treaties which offer an added benefit on dividend income, which in the form of underlying tax credit. So what underlying tax credit is? Underlying tax credit is the corporate taxes paid by the foreign entity on the profits out of which the dividends are declared. So if in our earlier example, we say that the foreign company earned profits during the year, paid corporate taxes thereon, and then the left out part, the remaining part was given as dividend after withholding taxes outside India. In this scenario, what type of credit would be allowed in India would be two. First one is the taxes withheld on the dividend income, and second is the corporate taxes paid by the foreign entity in its jurisdiction on the profits out of which such dividends are distributed. So there would be two tax credit available in such a scenario. There are some of the tax treaties only, like Mauritius or Singapore, which provide for these provisions. However, the entire amount, the total amount of FTC that would be available to the Indian entity cannot exceed the total amount of tax payable on such income in India. So there cannot be a situation that the tax payable in India is lower than the FTC available to an entity. I mean, the Indian government would not allow refund of the foreign tax credit. Now, compliances would remain the same as was in interest income. FTC can be claimed if filing Form 67, and appropriate disclosure should be made in the tax return. This transaction of receiving dividend income may also be subjected to arm's length testing. This we will take up in the same chapter of TP regulations.
Just one thing I would like to add here. See, when we talk about foreign tax credits, so it is very important that what is allowed should be as per DTAA. For example, something that has been withheld in any of the territory, any of the jurisdiction, which is like, for example, some country deducts 20%, but the treaty provides for 10%. So the credit would be restricted to 10%. The extra tax deducted withheld as per the local domestic laws would not be eligible for the tax credit in India.
This is really an important point to consider. Now, just to give a screenshot of the disclosures required in the return of income. This is Schedule FA, which talks about the foreign assets. These are to be filled by the residents, wherein the residents have to disclose the financial interest in any entity, the details of any immovable property held in outside India, any other capital asset held outside India, details of any trust created outside India. So all these are the details which an SSC, Indian SSC must ensure to file if they have any. Second is the schedule for foreign sourced income. This is the screenshot of the ITR form wherein the Indian taxpayers can.
So for income tax purposes, the disclosures are well within the ITR forms, and these are the screenshots from the ITR forms.
Yes, so in FSI, we have to disclose the country wherein the income was earned, then the head of income, the income earned outside India, paid outside India, the relevant article of the tax treaty referred to. And similar is the schedule TR, which is tax relief for taxes paid outside India. So all these information must be complied with by the Indian SSCs to ensure proper availment of FTC and disclosure of all the particulars of the foreign sourced income. Coming to the covering last portion of the possible source of income, that is in case of extension of, in case an Indian company extend guarantee to the foreign company, there could be a commission income which may arise from the guarantee. So for income tax purposes, guarantee commission is considered as equivalent to interest income, and accordingly the provisions applicable to interest income equally applies to guarantee commission. So as we have already discussed that interest income is chargeable to tax in India on gross basis, similar provisions would apply to guarantee commission as well. Now coming to the third phase, which is the exit phase. So in this case, we would be discussing what would happen in the hands of Indian company when they dilute their shareholding in the foreign company. There are various modes to dilute the shares in the foreign company. For the purpose of this session, we would be covering two. First is the normal manner of transfer of equity shares, wherein the Indian company would sell off its equity, would transfer its equity in the foreign company. And second could be merger of the foreign company. So taking up the first, at the time of sale of shares or transfer of equity shares of the foreign company, it would be considered as tax incidence in the hands of Indian company, and the gains arising to the Indian company would be taxable as cap gains. It would be considered as unlisted equity shares for tax purposes, and accordingly the period of holding would be guided by 24-month criteria. So if the shares are held for a period of less than 24 months, it would be short term. If they're held for more than 24 months, it would be long term. And accordingly, the tax rate would be 30% in case of short term and 20% in case of long term. The transfer of these equity shares would also be subjected to deeming provisions provided in the Section 50 CA, which provides that the sale consideration must be the fair market value of the equity shares. And if it is not the fair market value, then for taxability purposes, the fair market value would be considered as the sale consideration. So if we take an example that an Indian company is selling off its shares in the foreign, it's selling off its foreign equity. Selling price is decided at 5 lakh, while the FMV is 6 lakh. Although the inflow of funds to the Indian company would be 5 lakh, but Indian company would be required to pay taxes according to the considering sale consideration as 6 lakh. So there could be a direct dent on the Indian company on that part.
What this slide has covered is the transfer of equity shares when the direct shares of the Indian company are being sold. So this has a direct implication in India, and the taxes would apply in India. Generally, the structures do not permit. Earlier structures, it used to be like that. If one has to make an outbound investment to UK, so it could be by way of like from here it is Mauritius, then to Singapore, and then to UK, or possibly 2 layers within Singapore or 2 layers within Mauritius. So this was typically the 3D shopping, which I mentioned in the beginning itself, and the gains, they were not taxed in India. It just happened that the Mauritian company is selling the shares of the tier 2 or the step down subsidiary of another Mauritian company to somebody else. So the gains, they are not taxed in India, they are parked only in that jurisdiction where the capital gains are exempt. And for that matter, the Mauritius and Singapore, these two have been very liked jurisdictions wherein capital gains has been avoided by the investors. But with this principal purpose test and these MLIs into place, these type of restructurings and the 3D shopping, this will be really condemned to a larger extent. This is the remark I would just like to make here.
Okay, thank you. Now, this is all about the ODI phase, ODI and the phases at which taxable events may arise in case of ODI. There is one important aspect I would like to discuss here is relating to ESOP. Now, why ESOP I'm discussing in case of overseas investment? Because we have seen that the Indian employees, we generally see that the employees of Indian subsidiaries receive ESOP of the foreign holdcos, and this is just to retain the key talent. And these type of ESOPs, when exercised by the Indian employees, they are categorized as OPI under the OI regulations. So that is why ESOPs and its taxability holds importance for the purpose of this session. So when ESOPs are classified as OPI as per the OI regulations, there are various compliances, various regulatory norms that become applicable that triggers at the time of exercise. So an Indian employee must be cautious whenever an ESOP is exercised and that ESOP pertains to the foreign entity. So they have to ensure certain compliances before the AD bank, which are very well provided under the OI regulations.
I think we, as a professionals, we have seen number of notices from the income tax authorities that have been issued on account of these disclosures, that the foreign employees, they do receive the foreign company, the parent company's ESOPs, but because there is no monetary transaction, no visibility of that transaction, and therefore these are just not being not being the regulations not being complied with, the taxes not being paid with. So this is something which has largely occurred in last 2-3 years. And what should be the correct taxability? This is what is being discussed here in this slide.
So in addition to the regulatory norms that become applicable on exercising the ESOP, there is a taxing phase attached to it. ESOPs, when exercised by an Indian employee, is a taxable event in the hands of Indian employee. So when an Indian employee exercises ESOP, it will be taxed as perquisite in their hands in the year in which the ESOPs are exercised. There are provisions in the Act which provides for the manner of computing the perquisite value. As per those provisions, the difference between the fair market value of the foreign shares on the exercise date and the exercise price would be considered as perquisite value in the hands of ESOP. So at this point in time, it is very important to mention here that it is a point wherein the employee would be required to pay taxes on an income which is not resulting into any inflow of funds. So on the date of exercise, there won't be any inflow of funds received by the Indian employee from the foreign entity or from the Indian entity, but there would be a requirement on the Indian employee to ensure outflow of funds in the form of taxes. So this is a direct hit on the liquidity of the Indian employees. The funds will inflow only at the time when these ESOPs would be sold by the Indian employee in the open market. So just to summarize the taxability of ESOP, we have presented this. Taxable event arises on the date of exercise, and on the date of exercise, the perquisite value would be taxed in the hands of Indian employee. There is another taxable event that will arise at the time of sale of the shares by the Indian employee. The taxability would be similar to the one that we have discussed just few minutes back in case of transfer of equity shares. Capital gains would be computed as sale consideration minus the cost of acquisition. the difference would be and the tax rate would be applicable as per the tax rate applicable if it's STCG, then it would be 30%. If it's LTCG, it would be 20%. While computing the capital gains, the cost of acquisition will be the fair market value on the exercise date of such equity shares, because the Indian employee has already paid taxes to that extent. So while taxing ESOP, or on the date of exercise, it is very important to ensure certain compliances by the employer as well as employee. For employees, it is necessary that they evaluate the proper perquisite value and deduct taxes under Section 192. And for employees, it is very important to make appropriate disclosures in the return of income, because from the date of exercise, they would be holding interest in a foreign entity, which requires disclosure in the return of income. This is a brief example that we have given as per the provisions of the Act. We can skip this part.
Yes.
Okay. So this is all about the taxability, direct tax considerations that may arise whenever an Indian company makes an overseas investment, or whenever there is an allotment of shares to the Indian employees in the form of ESOP. Whenever there would be an exit, what type of tax consideration would arise? This is all about it. Now, there are further other tax considerations which one must bear in mind whenever an Indian company has an overseas investment.
Sure. Okay. One thing which is very, very important for this session is that despite it's a foreign company, can it be taxed in India as an Indian company? Or as a foreign company, but the entitlement of getting it taxed is with the Indian authorities. So we have to then refer to the provisions of place of effective management. They really hold importance. And where they hold importance majorly is, we have to take one example. Like these days, these startups are doing externalization, or they are flipping the structures. Okay, so the startup, they are homegrown startups. They started doing business in India, and later on, for so many reasons, they realize that okay, no, maybe Singapore is a better jurisdiction, or US is a better jurisdiction. That the reasons could be like IP protection, like could be they wanted to have investors, and investors are not comfortable with India for the reasons like ease of doing business. Then without going into a very mindful or a very detailed working, they just flip the structure as in they create a holdco outside India, they subscribe to their shares and then bring back the money and buy the Indian subsidiary shares. So the flip structures look like that the holdco is outside India and the subsidiary is in India. Now, what is important here is that where the head and brain is lying. The head and brain is lying in India. It's just that you have created a holdco for the purposes of some like the reasons we mentioned. So for those reasons, it is just the structure that has taken place. There is no appropriate person there who is actually managing the show. So in such a scenario, there is a likelihood, and there, I mean, it's something very important to be taken into consideration, that the place of effective management of that entity may get constituted in India. So in these provisions, we'll be discussing that when the poem can get attracted and what will happen if it is attracted. And the reason of just mentioning about the startups is that though it is applicable to all the companies which may fall within this, but for the startups, it's going like insane, and it is very common problem with the startups.
So in the initial part, we have said that for foreign companies, it is very important that their poem should lie outside India. Now, how to determine poem? Till now, we have in place certain guidelines issued by the CBTT, which provides for certain guiding factors which a company may consider to examine its poem in India. So there is a threshold of 50 CR, which says that if a company is having turnover of less than 50 CR, then there is no need to examine poem provisions on those companies. Now, for other companies, determination of for the purpose of determining POEM, there are certain approaches provided in the guidelines released by the issued by the CBTT. First approach is ABUI approach. ABUI approach is active business outside approach. So this is a number-based approach wherein if an if a foreign company satisfies certain parameters, then it would be considered as this company is having active business outside India. So the parameters are that if that company is having passive income less than 50% of its total income, if its total asset situated in India is less than 50% of its total asset base, if the employees situated in India or resident in India is less than 50% of the total employees, and the payroll expenditure of such employees is less than 50% of the total payroll expenditure, if all these four conditions are satisfied, then it is considered that foreign company is actually doing an operating business which is not regulated by India, rather it is regulated outside India, or it is operated in substance outside India. So if a company satisfy ABUI approach and majority of the board meetings of such company are held outside India, then POEM of such company is not considered to be in India. This is first approach. If this approach is satisfied, then it is established that POEM is not in India. For companies which do not satisfy or which are not engaged in active business outside India, there are certain other guiding factors to check whether POEM can at all be established in India, even though it's not having active business outside India. So second approach suggests two-stage process. Under first stage, the first stage says that in the first stage, one has to identify the key managerial personnel of the foreign company, and in second stage, one has to identify the place where these key managerial personnel meet to take the key management and commercial decisions of the company. So generally, it is the head office where the KMPs meet to take the key strategic decisions of the company. So generally, head office could be the determinative factor to determine POEM. If it's not the head office, if the board of director is segregated or it is decentralized, then it would be the place where they meet majority of the times to take decisions in substance. If it is a situation that the board of directors meet through VC or through telephone conferencing, through virtual network, and they are decentralized, then the place where majority of the directors reside could be the determinative factor for POEM. Or if in a situation there is a BOD which has delegated their part, for example, they have delegated their part to the executive committee, then the place where majority of the members of the executive committee meet to take the decisions could be the place where POEM is established. So these all are the guiding factors. There is no set formula given so far by the government to determine POEM of a foreign company in India. One may refer to these factors to determine whether at all POEM can be said to be in India or not. Moreover, it is not a snapshot approach which is to be followed. One has to look into the events occurring round the year to determine POEM of the foreign company. So one cannot say that, yes, at this point in time, all the members were situated in India, were coming to India for this period of time. So POEM should be in India. This should not be the case. Determination of POEM would be case-to-case analysis. Now, if all the approaches fails, I mean, if ABO approach does not help, if this two-stage process does not help, then there are certain other residuary factors to consider that the place where main and substantial activity of the business is being carried out could be the POEM, or where the accounting records are kept could be the POEM. So this is the guidance so far given by the authorities to determine POEM of a foreign company in India. To give illustrations, I would like to just give certain illustrations to clear the provisions. Let us suppose in the first case, there is a company Y which is situated outside India, and the company Y is having passive income of less than 40% of its total income. Passive income of 40% of its total income. The asset base situated, there is no asset base situated in India. There are no employees, and accordingly, there is no payroll expense. In this situation, the company will satisfy all the parameters of ABO approach. Since it satisfies all the factors, and if the majority of the meetings are held outside India, then the POEM of the company cannot be said to be in India. Considering second case where it fails two parameters, it could be said that the poem of the company may be in India if its board meetings are, majority of the board meetings are held in India. So this is a case-to-case analysis. There cannot be a set answer to any query. Now, what happens if the poem of a foreign company gets established in India? What will happen to that foreign company? There are provisions in the Act which says that if poem of a foreign company is established in India, then for taxability purposes, that company would be considered as a resident company. We have already discussed that if a company is considered as a resident, its global income would be subjected to tax in India. So if a foreign company is considered as a resident company because of poem, its entire income, which is it is earning whether from India or from outside India, anywhere, it would be subjected to tax in India. On the top of this, the tax rate that would be applicable to these type of foreign companies would be 40%. It would not be the normal corporate tax rate applicable to the Indian companies. It would be the 40% tax rate, which is otherwise applicable to the foreign companies. So foreign company would be considered as resident. It would be its global income would be taxed in India, and that too at the 40%. These are the consequences if the poem of a foreign company gets established in India. We have provisions in place which provides for the manner of computing taxable income, the claim of depreciation, then how to claim set off and carry forward of losses, how to claim this benefit of tax treaty specific to these companies whose poem gets established in India. So we have section 115 JH in place, read with relevant notification, which is notification number 29/2018. These are the provisions which provides for the manner of computing taxable income of the companies whose poem gets established in India. So these provisions are quite extensive one, and they're
difficult.
Right. And their applicability is to be examined on case-to-case basis. Coming to the next topic, which holds relevance in case of overseas investment, is transfer pricing regulations. So we have already understood that that OI is making investment by an Indian company outside India, either in the form of equity or loan. These type of transactions may get covered under the TP regime if the Indian company and the foreign company gets classified as associated enterprise under the TP regulations. So this term associated enterprises is defined under the TP regulations, which contains various parameters of establishing relationship between an Indian company and foreign company. For instance, if an Indian company holds 20% or more of the equity capital of the foreign company, then as per the TP regulations, these two entities, Indian company and foreign company, would become associated or related to each other. If they become associated or related to each other, then any transaction entered into between these two entities, either it could be in the form of any business transaction, it could be in the form of any further issue of equity shares, it could be loan advancement, it could be interest transaction, any transaction entered into between these two related entities would be subjected to transfer pricing regulations. So under TP regulations, the Indian company would be required to adhere to certain compliances, which are: first, Indian company would be required to file Form 3CEB, which is a certificate from a chartered accountant, which contains details of the intercompany transaction between these related parties, the pricing at which these transactions were entered into, and the arm's length pricing of these transactions. So what is the arm's length pricing? Arm's length pricing is the simple price at which any transaction would be entered into between two unrelated parties. So if there is a transaction between an Indian company and foreign company which are related to each other, those transactions would be tested whether these transactions have been entered into on arm's length basis or not. And if they are not, then there could be certain adjustments in the hands of Indian company.
So if we talk about income, majorly there will be like three type of incomes possibly, like interest income, it could be dividend income, and commission, guarantee commission income. So for interest and guarantee commission income, benchmarking analysis has to be conducted. That if in an independent scenario, what would have been the rate of interest or commission. And for dividend income, there has been a debate already that whether at all this will classify as an international transaction or not, because this is a unilateral act and this a shareholder activity, and therefore there's already a debate. So I think the approach that has been taken, that dividend income should not form part of the transfer pricing, And as far as interest and guarantee commission, definitely there has to be a proper benchmark analysis that should be there to benchmark the arm's length.
Yes. So the second compliance is related to 3-tier TP documentation which an Indian company would be required to maintain. This is based on the applicability only. First is the local file. This is generally applicable to all the companies who are required to file Form 3CEB. This is a TP documentation wherein the Indian company would be required to ensure documentation of all the transactions, intercompany transactions, their pricing policies, their arm's length testing, the basis on which arm's length pricing has been derived, their industry to which that company belongs, and many other documents. So we have proper rules in place which provides for a detailed list of documents which the Indian company are required to maintain under the local file. Second is the master file. So this is a high level information or a high level filing. This is applicable only if the console turnover, I mean, these type of filings, this master file or CBCR will apply only when there is an MNC group. So if there is an Indian company who has made investment outside India, this becomes an MNC group because there are two jurisdictions involved in this picture. So in this scenario, it is important to examine whether master file or CBCR is applicable to the group or not. So master file for filing for applicability of master file, there is a threshold that if the consolidated turnover of the group is more than 500 CR, and there is a international transaction exceeding 50 CR or 10 CR in case of intangibles, only then master file compliances would be applicable. And if at all it becomes applicable, it is an extensive, very detailed form which contains very high level information of the entire group, including its TP policies, its IP holdings, overview of the group business, its supply chain, its value chain, its customer base, and everything. So all these things are required to be reported before the income tax authorities if at all master file becomes applicable. Third is the much higher level of reporting, which is CBCR reporting. This is a very specific information and it contains number details in the form of revenue, PBT, asset base, employee base, taxes paid, major business activity of all the companies of the M&E group based on their jurisdiction. So if there is a multinational group which has presence across various countries and CBCR is applicable to such group, they have to report each and every parameter, that is revenue, PBT, taxes paid, accrued, number of employees, tangible asset base, major activity, etc. for each and every entity located in every jurisdiction. So this is a very high level documentation which is generally exchanged between the government of various countries to perform a better risk assessment on the M&E groups.
And threshold for this CBCR is quite high, like it's 5,500 crores, 7,500 crores. And I think it will only apply to the companies, very big companies.
Very big companies. It will
like for example, we can take an example of Dabur, which is a listed company, and it's applicable on Dabur. So likewise, these are the reports. I think majorly, if it's a small company making an ODI, an overseas investment in any of one of the jurisdiction like UK or Dubai or some other, I mean, any African country or so, the local file would definitely be applicable as and when this investment is being made, because every subsequent investment would be subjected to transfer pricing. Any income deriving would be subjected to transfer pricing, as well as the exit mechanism. Again, it will be by way of share sale or something. It will also be covered within Form 3CB and local file. The master file and CBCR, these are only applicable when the threshold exceeds. Like for master file, it is 500 crores, and for CBCR, it is 7,500 crores. Just last one thing on this slide. For infusion of funds or for exit, generally the share valuations which are being obtained are considered as a benchmark for the purpose of the valuation itself is considered for the purpose of benchmarking. Okay. Lastly, 2-3 slides, I think, on GIFT City. This has been extensively covered yesterday as well by an expert who talks very, in detail on the GIFT City and the provisions, and to some extent taxability as well. So what we have covered here is only with respect to the IFSCs, the exemption which are covered. to the IFSC and to the Indian investor. So GIFT City is also about non-resident investors, about the funds, etc., offshore funds. But the taxability here has been confined to making the ODI or the OPI. So we'll just cover that as well. Yes.
So as we all know that Gujarat International Finance Tech City is the first IFSC introduced. For foreign exchange laws, it is considered as a deemed foreign entity, but for taxation purposes, it is considered as a resident only. There is no as such blanket benefit or deduction available to the IFSCs. There are only specific provisions which become applicable if it is a specific entity located in IFSC or if it is a specific investor, be it Indian investor or foreign investor. So as ma'am said that there had been a detailed discussion,
within GIFT City is a broader term. Within GIFT City, there are IFSCs, SEZs, wherein if we take the registration, we'll get some exemptions. But again, within that city, there are hospitals, there are residential units. So there are no as such exemptions to the individuals residing there or any such thing. It is only the advantage will flow to the units that have established their entities there, those who have got the registration from IFSCA authority, and what are the deduction, what are the advantages are listed. And secondly, to the residents as well, those who are going to invest in the GIFT City in any of the stock exchanges that is being operated within IFSC. So that, for example, we take an example, if I as a resident invest money in the foreign in some US on some US stock exchange, the US stock, whatever I'll be earning, it will not be treated as a listed entity. But if I do invest on IFSC stock, on the IFSC exchange, it will be treated as a listed entity. So that is the major differentiator which we would like to highlight here for the purpose of taxation. So these are the two taxes which we'll be briefly discussing.
Right. So first one is the benefit available to the units located in IFSC. The provisions of the Act provide for a deduction to the units to the units located in IFSC or the offshore banking units located in SCC. So the benefit is available in the form of exempting their 100% profits for a period of 10 consecutive years out of the block of 15 years. And that block will start from the year in which the prescribed permission is obtained by the IFSC unit. For the IFSC unit, the only specified income would be exempt under the Act. The specified income have already been listed in the Act, which are income from OBU in an SCC or income from banking business with undertaking located in SCC or any undertaking which develops and operates and maintain an SCC, income from any unit in IFSC, or income arising from the transfer of aircraft or ship, which was leased by the IFSC unit to a person, subject to the condition that unit has commenced operation on or before March 25. So this is one of the benefit available to the IFSC unit, wherein their 100% profits would be exempt for a consecutive period, for 10 consecutive years out of a block of 15 years. To claim this benefit, to claim this deduction, there are compliances that are required to be made by the IFSC unit. First one, they are required to obtain a report from a chartered accountant, certifying the profits derived by them from derived by them from such IFSC unit. Second, they are required to file return of income and claim deduction under the appropriate section in the return of income to claim the benefit. And third is that they are required to file a copy of the permission along with the return of income. So this is the benefit which is available to IFSC unit. Now switching to the second benefit, which is available to the Indian investor, which ma'am was briefing. This is a benefit available to the Indian investor investing in the foreign listed securities. So let us understand it with the help of an example. There is an Indian company investing shares into the foreign company through foreign stock exchange. The shares are being sold by the company through foreign stock exchange, and there is a short-term capital gain arising on such shares. For the purpose of taxability in India, these the sale of these shares would be considered as sale of unlisted equity shares because foreign stock exchange is not considered as a recognized stock exchange in India. Accordingly, the short-term capital gain arising on such transaction would be taxable at the rate of 30% in the hands of Indian investor. While if these shares are purchased and then sold by the Indian investor through a stock exchange situated in IFSC, then this stock exchange is then even though this stock exchange, even though there won't be any STT paid by STT payable on this transaction, there is a benefit given under section 111A of the Act that if the transaction of sale happens through IFSC stock exchange and it happens in foreign currency, then the reduced rate of taxation of 50% would be available to the Indian investor. So this is a clear benefit available to the Indian investor, wherein their capital gain would be taxed at a concessional rate of 15% instead of the normal tax rate of 30% if they transact their purchase and sale through IFSC stock exchanges. This is all from the taxability purposes as far as ODI is concerned or GIFT City is concerned. I think we can take up the questions now.
Yes, sure. We have some queries in the chat box. So, ma'am, the first query is whether TCS is applicable on ODI and OPI.
So in case of an Indian company, if an Indian company is making investment outside India, I don't think there is any TCS applicable.
So see,
However,
LRS, yes.
However, in case of a resident individual, if it's making any LRS, then TCS would be applicable.
Okay.
As per the recent amendments. Yes.
All right. So the next query asked by the participant is there any case law where valuation as per income tax overrides the valuation under FEMA?
Okay, case law, maybe we can just look for that. That's an interesting thing to look at. But definitely there is a difference between how the valuation is being conducted under income tax. It says NAV, and the FEMA is majorly relying upon the DCF method. So if there would be anything available in terms of, like cases, we would be happy to look at.
However, at the assessing officer level, if you talk, it is very difficult for assessing officer to accept any valuation other than the valuation method prescribed under the tax rules.
The next query is whether credit can be taken for tax paid on dividend but exempt under section 80M.
As per technical provisions, no, tax credit can only be availed if there is a doubly taxed income. So if there is an Indian company which is receiving foreign dividend and that foreign dividend is declared by the Indian companies passed through to the Indian shareholders, so there won't be any double taxation of the dividend income in India. Although there would be, but it would be in the different hands. So technically, FTC would not be available if 80M is claimed by the Indian company.
All right. The last query asked in the chat box is whether residents of GIFT City would be taxed as resident or non-resident.
So for income tax purposes, they will continue to remain as residents of India only. So it's only for the FEMA guidelines that the clarification is there.
Okay, perfect. Dear participants, the chat box is still open for all your queries. You can write that in the chat box so that we can clear your doubts if you have any. I must say, ma'am, already your slide was amazing. The whole session was amazingly coordinated and well informed by you. And there are so many takeaways, and I can see that there are so many professional opportunities also in the same field. We are not getting any other query, so I believe we can close the same.
Yes, madam. So we can present certificate.
Yes, sir. For sure.
Yes. This is for our guest speaker, C.S. Survi Bansalji. Madam, kindly accept it.
So is there a formal way to accept it?
Just acknowledge, ma'am.
Okay, thank you.
Yes.
And I'm really
We will send
thankful to
also.
my colleague Agartha. She has actually put in all the efforts here in the presentation and in deliberating the session. Thank you.
Yes, ma'am. We will send also through
Yeah, it'll
courier
be great.
to you.
It'll be
Yes,
yeah.
yes,
Okay.
yes.
So can we
Also for
have
your
can
yes,
we
yes,
have this certificate for Agartha as well?
yes, ma'am.
Okay, thanks.
Yes, yes.
That's really.
It needs to
Thank
be
you.
there. Both
Thank you.
presenters have actually put on lots of efforts to make the session informative and easy for us.
This is
Thank you
for
so much.
C. Abhishek Singh Chauhan, our coordinator for this webinar. And now this is for
Oh, great.
Oh,
Thank
So
you.
quick.
Thank
we
you.
have it for our
moderator,
course.
madam. Yes, Ayushi Khanna ji.
Thank you, sir. Thank you so much.
And this is for Agrata, madam.
Thank you.
Thank you so much, sir. I hope all the participants have enjoyed the session and got lots of information. And definitely, if you still have any query, you can reach out our team. And we have got some queries regarding getting the presentation which you have shared with the participants. So definitely, I have that with me. We'll try to provide this to your audience. Thank you so much for your time. It was great having you with
Thank
us.
you.
Thank you.
Thank you. Thank you.
Good evening, everyone.
Yeah. Bye-bye.